The universe of alternative investments in equity does not limit to PMSs only. Another industry that is growing today at even faster pace is the AIF industry. AIFs or alternative investment funds are a vast category in itself, and one of the prominent category is a long short category of AIFs. These funds use complex strategies to hedge equity portfolio and try to significantly contain the downside. Given the rise in volatility, uncertainty, and ambiguity, a lot of investors are looking at long short AIFs with an approach of capital preservation along with capital appreciation. We know that the last decade was that of quantitative easing, and the current decade is witnessing a decade of quantitative tightening. Given such a macro scenario, our next panel will discuss what's in for long short investments. Quantitative tightening, elections 24, and global uncertainties. Does this provide a scope for long short investments? Our next panel, ladies and gentlemen, will address this exact question. It's now time for me to introduce you to our panelists. Our first panelist is Mr. Utsav Mehta. He's a fund manager for alternative equities at Edelweiss Asset Management Limited and manages the Catalyst and Consumer Trends Fund. He plays an integral role in the management of the alternative equity fund basket at Edelweiss. Before joining Edelweiss AMC in the year 2018, he was heading the industrials and infrastructure research at Ambit Capital, part of the #1 ranked Indian industrials research team in Asia Money for consecutive years, 2017 and 2018. Our next panelist is Mr. Rohit Karan. He's the AVP Investments at ICICI Prudential AMC. He has over 12 years of experience in Indian equities and fixed income markets. At ICICI, his role includes investment research, analyzing macro and devising investment strategies for equity-oriented funds. He is also the fund manager for the ICICI Prudential Enhanced Dynamic Equity Fund. Mr. Rohit graduated from IIT Kanpur with a BTech in Electrical Engineering in 2007 and completed his MBA from IIM Ahmedabad in 2009. This session will be moderated by Mr. Namesh Changani. He's the head of research at Avendus Capital Public Markets Alternate Strategies LLP. He has spent over a decade and a half in the Indian market with specialization in equity research. Namesh was earlier associated with Ambit Capital Private Limited, which was one of the largest hedge funds in India. Over to you, Mr. Namesh.
Thanks, Chakli, and welcome Utsav and Rohit to discuss about the topic, which is, I think, discussed at the global level right now, quantitative tightening, global uncertainties, election 24, which I believe would become a more interesting topic in the next 3 to 4 months. So around the scope for long-short investments, I'll rather start with both of you, Utsav and Rohit. How do you see the importance of long-short funds in an investor's portfolio? Let's address that part first, and then we'll move on to these uncertainties, which in a greater detail. But if you can talk about the importance of long-short fund, if you can also talk about how, from a layman perspective, one should actually look into this aspect. Yeah, Utsav, first to you.
Wonderful. So thank you so much for that, Namesh, and thank you so much for having us on this platform. It's our pleasure. I'll just quickly jump to the first part. The way we look at it, a long-short fund is a very integral part of a diversified equity portfolio that an investor would have, and it gives you access to 3 things that you wouldn't traditionally get access to. One is obviously taking advantage of market calls in either direction, either through F&O or through leverage, or sometimes even accessing special situations such as delisting, open offers. These are avenues, as we all know over the years, market aren't unidirectional, and some of these strategies are known to enhance returns. The second reason why it's an important part of a portfolio is that traditionally we typically tend to look at adding risk to our portfolio as we want to enhance returns. So you would start with a blue chip fund and then go to mid caps and small caps and then a PMS. But typically you would never find a way to maintain some of those returns while also stepping down on the risk ladder. And that's where I think long shorts play a very critical role. And finally, sort of at the background, it is unsaid, but long short funds typically globally tend to be at the cutting edge of technology innovation. Some of those strategies that long shorts typically tend to come with become mainstream years later. So it gives an investor access to those. If I were to put it in layman terms, think of having a nice wardrobe. Probably 80% of your clothes would be something that you would pick up at a mall, but you would also want something customized to your height, your weight, your body shape for those special occasions. And I think a long short is typically one that fits in there.
Perfect. No, that's an interesting point you highlighted about the risk curve, laddering down the risk curve while managing those returns. So, Rohit, how would you define a differentiated long short fund in an investor's portfolio? Like what part of the portfolio it actually fits in the risk reward in the risk reward framework?
Sure. So what we have seen over the last few years is there's a huge amount of volatility in the market. There are events which could not be predicted earlier, like geopolitical things, liquidities coming off, rates going higher, and during these times, it becomes difficult to generate alpha from a pure long only strategy because the correlation of the stocks and the indices, the country specific factors come into play. A long short fund, because it is usually less correlated to broader markets, that can add a good amount of alpha and uh, becomes, placed somewhere. It's a little lower risky compared to a pure equity fund, and becomes a crucial part in the investor's portfolio because the fund managers can take advantage of rapidly changing market environments and also the gaps which exist on the valuation front.
So great. So basically, you are saying uncorrelated kind of a returns, and it basically lies somewhere between an equity fund and a debt fund, where the risk is slightly higher than the debts, and returns are similar to or between equity and debt. Interesting placement of these long short funds. So basically, in the global markets, we've seen that long short funds are being of a very high scales. How do you see India? It's a very nascent stage. If you can talk about how your funds have evolved, if you can talk about different strategies in the long short market at this point in time, how do you actually contain these risks which we are talking about, right? So yeah, Rohit, if you can start with this, then I'll take the same question to Utsav.
Sure. So the category has grown quite phenomenally. If you look at the Cat 3 AIF data, we have grown about 60% in the last 2 odd years, and the momentum looks like will continue for quite some time. Because as events are playing out, the investors are also realizing what their actual needs are, and basis this, they're also they're also coming into these products. If you look at global markets, developed markets, in US, let's say the hedge funds account for about 5% share. We are still way below that, and there is a huge room for these products to develop as markets evolve from here.
Utsav, you want to add something to this?
Yes. I think interesting point that you raised about various strategies. So I think it's important for an investor to understand that with a traditional mutual fund investment, while you would get typical buckets to place similar kind of funds in, a long short, no two long shorts on the street may be alike. For ourselves, we are a long biased long short fund. We try and generate alpha while maintaining lower risk, but predominantly remain long. We are of core belief that there are two Indias, a majority of it being fast growing, value generating, well-run companies. But at the same point of time, you also have a bucket of companies which don't deliver cost of capital. And an investor can structurally take advantage of both sides of the spectrum. So while we would predominantly remain long, we would try and take advantage of both sides. At the same point in time, there are peers that sit at various parts of the spectrum as far as risk and return go, all the way from enhanced debt yields, all the way to uncorrelated pure alpha returns.
Perfect. Perfect. Okay, so now let's jump into some real life examples. So recently we've seen unprecedented risks associated to the funds, right? So we'll talk about the latest and the largest one being COVID. So how does a long short fund do differently than a normal mutual fund during the pandemic times? If you can talk about that part, since you were mentioning about a long only fund, right? A long bias, long short fund. So can you talk about the portfolio strategy during these times? How one manages it and how does it benefit investors at large?
Great. So since you mentioned COVID, let's just speak about COVID, but I think the same thing is true for major events that happened prior to COVID, IL&FS. And let's be honest, in today's day and age, there is something or the other that's going to happen every 2 years, every 1 year, right? So we shouldn't be surprised by that. We have a proprietary model at the background, which sort of points us towards what percentage or how much of short exposure we have. And typically right prior to COVID, or as we were moving into COVID, we were constantly increasing our short exposure to the market. We prefer our short ideas are not always index linked as well. We also like identifying poor quality businesses or what we believe are going through poor phases and take advantage of that. And coincidentally, luckily for us, during that period, those companies tend to react on the downside even more so than the benchmark. So to give you some numbers to put in perspective, and I'm just throwing out some examples. If let's say the market does a -20 in this period, your long portfolio, typically we would try to outperform that. And then your returns would get enhanced by the shorts. And on top of that, any sort of special situation opportunity that comes through.
Right. Rohit, would you like to share about on this aspect itself, like on when the COVID hit the market or when the demon happened, IL&FS happened? So in the past events, how do you see these long short funds basically stands out versus a normal different asset class in equities?
Sure. So COVID was a big reset point, I think, from an investor standpoint, because then they actually, a lot of investors realized that they have sufficient equity exposure. And with rates falling to the levels they were, so they needed something which would generate a higher return from debt and at an absolute basis. So that actually led to a boom in this segment. We predominantly have been options players, so the enhanced volatility in the markets are actually helpful for us. And if you look at the journey of AIFs, the products that are being launched, as markets have moved up and equity looks overvalued, you see products which are coming in to take advantage of that thing also from an enhanced perspective. So there's a big reset happening, and the investors come to know of their needs, and that will bring more products to the market.
Is it safe to say that it covers the tail risk to a significant level?
Absolutely.
Right. Okay. Okay. So now let's move on to elections 2024. Now we know that from next month onwards, we are having 3 state election and leading up to 20 election in 2024. How do you see these kind of domestic events play out? How do you design your portfolio accordingly? Because whatever the outcome is, there is a risk and heightened volatility. How you guys manage this volatility? How does a long short fund behaves differently than other asset classes in this case? So Rohit, if you can take it first, then I'll take it to Utsav.
Sure. So, talking from our perspective, we are predominantly, we have models to tell how much exposure we want to take on markets. The absolute return fund is something where we prefer to be delta neutral, not exposed to markets, try and take advantage of heightened volatility, which I suppose will increase as we get closer to elections. So it's a natural beneficiary of that kind of scenario. The other one, the fund where we have models which actually tells us how much exposure we need to take on the markets. Again, it's a very model specific thing which takes into account different macroeconomic parameters. So whether there are elections or other events which come in, the models will guide us, and volatility will be something which will help us as we go ahead.
Right. So they are the pre-designed model which you're talking about, which helps you navigate this kind of a volatility, which may be a year down the line.
Sure.
Right.
Yeah.
Pretty interesting. Utsav, how different approach you will take, because you also have a long shot. So because this is a different strategy, all the other strategies which you understand in the long shot, how differently you'll take those?
Right. So for us, it's slightly different. From the long side, we are consistent over cycles. We believe, I think some of the philosophies expounded by various many guests who've come before us on this platform stands true for us as well. We're patient long-term investors in our cash portfolio. We like having high quality value generative businesses. We make tweaks to account for disruptions or waning industries, but we try to keep that to the minimum. At the same point in time, as you move into high volatility periods, our own models allow us to manage the volatility through increasing shorts, or even special situations start throwing out significant amount of alpha during such periods. Because you see a lot of corporate activity pick up, especially when prices are down or fluctuating, and that allows us to capture that as well. So it allows us to enhance our yield both on the long side, and obviously any sort of fall gets captured by the shorts.
Perfect. You talked about it allows you an opportunity to figure out the short opportunities in this case as well. If you can also talk about, because it's a political risk, it's a large domestic event, are there any models which suggest that these are the certain sectors or these are the certain stocks which should go short on, or it's typically you take a long cycle view while going short on those names?
It's a combination of both. We're very fundamentally oriented even on the short side. I think there are obviously a whole set of, I would say, capital destroyers out there. But then there are also, at the same point of time, capital destroyers whose capital destruction increases because of political risk or interest rate risk. And fundamentally, it's in a way sort of doing the exact opposite of what you do on the long side, right? Which is to basically say that this company is not going to generate your cost of capital and therefore it's going to fall. So it's a model that allows us to sort of dictates how much we should be short, but within that, we use our vast expertise of a 5-member team to pick and choose the stocks that we want to go short on.
Perfect. So basically, we have tools to enhance our returns, especially in these domestic uncertain scenarios, which may happen in, say, next 12 to 15 months. Very interesting. Now, taking a step forward, geopolitical risk, right? Now, that is one risk which has become large since that Russia-Ukraine war has started. Before that, there was US-China trade war happening. You don't know whether it has been resolved or not. So looking at those global risks, does your models also capture these kind of a geopolitical risk into account? And how does a long short fund basically behave in a global geopolitical risk scenario?
Right.
Yeah, Utsav, if you can take this.
Yeah. Great. So I mean, look, it's difficult to capture these things sometimes in a model, which is why we pride ourselves in our bottom-up stock picking, even on the short side. But what I would say over here is that there is a certain self-correcting mechanism that's already built into the market, which sort of throws out very many indicators, right? So when the market valuations get stretched and unreasonably so, you see the F&O universe or the stock universe constantly expanding. More and more names get added as both liquidity and market caps go up, which itself provides us a much wider pool of stocks to then pick and choose from. On the flip side, where the market itself is signaling to you that, hey, not the best time to be short, you would automatically probably see that pool shrink only to the highest quality companies where you would anyways be struggling to find shorts, right? So if you ask me, right after COVID's crash, over the next 3 or 4 months, a huge tail of poor quality companies got eliminated from the F&O universe, where our own ability to pick and choose reduced, which itself sort of provided us with a self-correcting mechanism to say that, okay, we don't need to be as short now as we were earlier. So while we have a model, but at the same point of time, we're fortunate enough that the itself gives us a great indication.
And Rohit, about what's your view on this aspect? Does your model, do you design your model to consider these uncertainty which you've seen in the past, which may happen in the future? And how could you lower your risk looking at these uncertainties?
So models, I mean, I don't think models can capture geopolitical risk in advance. But once we enter turbulent times, we have our risk management framework, which takes some kind of a dominating role at that time. So we reduce risk whenever we enter into turbulent times, and then the focus changes from how much. I mean, capital preservation is also quite important because markets will give you opportunities to make money later on. So the risk management framework is actually helping us during such turbulent times.
And
For the other funds, we obviously, yeah, sure.
No, interesting point you raise about the the capital preservation in this case.
Sorry, yeah. So if I may just add, I think it's not only geopolitical risk, it's also, globally interest rates are going up. Right. And I think the reason why we believe long shorts are at a sweet spot in a way is because as interest rates go up, right, as capital becomes dearer, people start questioning capital efficiency a lot more, unlike what you've seen in the last 2 or 3 years, where you probably on the whole seen a one-day rally. And when that happens, you get 2 very distinct buckets in front of you, right? Those that are capital efficient, that will generate value on the long side, but at the same point of time, as Rohit would capture, as his models would also start capturing, there's also value to be captured on the other side, because the capital efficiency of these businesses have deteriorated when interest rates go up. So I think as we progress through the next 2 years and capital efficiency starts getting questioned more and more, especially from poorer quality companies, you'll see long short funds benefiting disproportionately.
Right. And this leads me to another part of our topic, which is global recession, right? The global uncertainty. I'll rather put it a global recession regarding that. So there's a global recession. There's talk about quantitative tightening. Now, these are economic risks, right? These are very different from what we've seen in the recent past. right? Business model goes for a change, complete change during a recessionary time. What we've seen is just a financial crisis in the past, but never a recessionary scenario. So as all the experts are talking about global recession, what's your view? How are you viewing it differently? And how can an investor be confident about ability to generate a higher return with a lower risk in the long short fund?
Okay,
Yeah,
that?
how are you? Yeah, what's up, please?
Yeah, sorry. So I think it's crucial for us to understand that global recession may or may not take place, right? At least I don't claim to know either ways. But being a long bias fund would give you a clue that we're firm believers of the directionality of the India story, right? We believe there will be speed bumps along the way, but on the whole, we believe that the country should do well over the next 5 to 7 years, irrespective of what gets thrown its way, and which is why we put our hat on the long biased ring. So we continue to do, even in a recessionary scenario, on the long side, as you would do in a non-recessionary scenario, bar a few tweaks here and there, but we would be actively focusing on our short side at that point in time.
Right. And Rohit, quantitative tightening, now that has started now. And we've seen central banks' balance sheet size, the kind of increase they have seen during this COVID time, it was almost 70%. Interest rates have started moving up. And that has impacted the emerging markets as well at that point in time. So what opportunity does it offer to a long short fund in a rising interest rate or an elevated interest rate scenario? I know Utsav has touched upon that aspect in the previous question, but just wanted to understand from your side that in a rising interest rate scenario, when we are talking about a quantitative tightening, which has impacted emerging markets and India in the past, when we saw just a small hint of quantitative tightening, how do you see we navigating out of it if that event actually unfolds in the similar way that quantitative easing was there in last 4 years?
Sure. I mean, as far as EMs go, there could be a fair bit of problems because there are some economies which have external debt that they are really stressed on that front. India probably is in a much better shape compared to what we were in the previous instances. So I think we should be able to navigate it. Our the rates are going to be higher. So that is a broad conclusion which is there at the markets. And the questions which need to be asked is are valuations fair at this point? Are we I mean, the fact that we are using the same forward P multiples that we've been using the last 5 years, are they fair? Is it fair to use it again at this point in time? So probably valuations are little out of alignment with the realities, and that offers a fair bit of opportunity from a valuation based long short models. Also, because liquidity is coming out of market, so probably volatility will increase, and volatility increasing is actually good for options related kind of a long short fund.
Perfect. So basically, you see these uncertainties or those uncertain times, be it quantitative tightening, be it domestic elections, or be it these global recession, these rather creates more volatility, which is create more scope for these long short investment. This is the message which I'm getting from you. And the one important message which I got was a capital preservation, which becomes a paramount important. What Rohit mentioned, I believe, in his comment, that in these uncertain times, capital preservation becomes important. That itself can create a big delta. So I believe this leads me to the last question to both of you. On the regulatory framework currently, so the scope is big. The returns in the uncertain environment could be better than most asset classes. But can you talk about the current regulatory framework? Is it supportive enough for the long-term growth of these long-short funds in India? Over to you, Utsav, first.
Yeah. So there are a couple of areas that we can improve. Clearly, as Rohit mentioned, in the last 2 years, the industry has done a 60% sort of an AUM growth, which is a fabulous number. Where it can be done better is and recently, as most would know, there were some new rules that SEBI's come out with for Cat 3 AIFs in terms of trying to fix distribution fees and various other aspects. And we think that those are for absolutely necessary and for the positive. But at the same point in time, I think that there is also a discussion to sort of understand whether the minimum should be raised for Cat 3 AIFs. And it's already at 1 crore, which is extremely high. You raise that further, you narrow down the pool and make it more inaccessible. Alternatively, you would also probably look to make the accredited investor framework a little bit more robust so that a lot more investors can sign up for them. Currently, it's cumbersome, basically making it accessible to a wider set of public. Finally, our favorite talking points, and Namesh, we've spoken about this multiple times before, is the pass-through taxation bit, right? So not only do fund managers have to work hard, but we also have to work hard to not only deliver returns, but also to pay the tax on top of that, since it is taxable at 42% at our end on the F&O side. So not only are we sort of generating returns for the investor, but also to cover that, and that can be a handicap at times.
Perfect, Utsav. Thank you, Utsav. Thank you, Rohit, for this lovely discussion. I believe the key message we got from this discussion is these uncertainties are great for long-short funds, as they can contain some part of risk and deliver a better return or enhanced return, in Utsav's word. So over to you, Akriti.
Well, thank you all so much. I hope all of our viewers are enjoying these power-packed and insightful sessions that have been taking place through the day.